Okay guys, so in this part 2 of IAS 12 of deferred tax, guys, we are going to do some application that you need to know when it comes to International Accounting Standard number 12. Okay, without wasting any other time, guys, let's look at the question paper that we have. Okay, they say that Afrox Limited is a company that operates within Limpopo province, and Afrox Limited has 31 December reporting period end. Then they said the information below was extracted from financial record of Afrox Limited for the reporting period ended 31 December 2018. Okay. Then they said a statement of financial position. They give us a machine, equipment. They also give us statement of profit or loss. Okay. Then they said the deferred tax balance on 31 December 2017 is nil, and the required part, they say that we need to calculate a deferred tax expense for the year end 31 December 2018, and they give us the columns that we need to use. They said number 1 is carrying amount. If we are talking about carrying amount, we are talking about accounting books. Accounting books. This is what we record under income statement or a balance sheet. Okay, then we have a tax base. A tax base, obviously, guys, we are talking about implication or laws of tax. What we did when we prepare our tax. What we did when we prepare our accounting. Just like that. Then temporary different is the difference that we found between these two. It's like you are subtracting and you find what is the difference. Okay, then deferred tax, you are going to take a temporary difference and multiply by, in this case, we are going to use 28%. Okay, then after that, you need to indicate whether it's deferred tax liability or an asset according to what? To the amount that we got and the understanding of temporary different. Okay, let's start with number 1. It's a machinery. They said that the cost price is 550,000 and depreciation is 5 years in accounting. Accounting, we calculate depreciation, but when it comes to tax base, which is SARS or tax, we use capital allowance. So if you check, you will find that in accounting we are using a 5 years, but under tax they said that it's 3 years. Okay, obviously there will be a difference because we are going to divide by the different amount. Okay, if you take 550,000, in this case there is no need to calculate a month because it's from 1 January and they said our year is ending December. Okay, so number 1, which means that we are going to say amount of 550,000 divided by 5 years. Okay, 550,000 divided by 5 years. This one is going to give us amount that we need to record under accounting, which is 110,000. This is the calculation. Okay, now we have to check tax as well. We need to divide by 3 because they said useful life under tax, under capital allowance is 3 years. Then in this case, we're going to get 183,330. Okay, because this is expense which we have to deduct, obviously we must show by a bracket. Okay, and if you calculate the difference between these two, you're going to get amount of 73,330. Then after that, you need to multiply by 28%. 73 multiplied by 28%, you will get amount of 20,533. Okay, also guys, brackets, it doesn't matter as long as you indicate the correct class, whether it's liability or it's an asset. Okay, now we have to indicate, is it liability or is it an asset? If in this case we claim a depreciation of 110 instead of claiming 183, because they believe that SARS is the one which is always correct. Okay, SARS In other words, the SARS, they don't do mistake, which means that this is what was supposed to be deducted, but we deduct this one. In other words, if you deduct a less expense, simply means that you are going to get a higher profit. The more we have more expense, the lesser profit, but the lesser expense, the more profit, which means that in this case we are owing SARS. It's going to be liability, therefore it will be regarded as a liability. It will be liability. Okay, now let's proceed to the next one. The next one is equipment. Okay, equipment, they say that the cost price on 1 January 2018, it was 855. It was 855,000. Okay, and they said in accounting we need to use useful life of 3 years divided by 3. Okay, then if you do this calculation, you are going to get amount of 285,000. And let's check what did they say about SARS. They said year 1 is 50%, year 2 30%, year 3 20%. Okay, we're going to use 50% in this case because it's the one which is year 1. Okay, which means that you're gonna just multiply by 50% or divide by 2. Okay, it's gonna give you 427,500. Okay, now you need to calculate the difference. This one minus this one is gonna give you 142,500. Okay, then after that, the next step is to calculate 20%, 28% of this. Then it will give you amount of 39,900. All right, if you check, even in this case, guys, we claim a less amount instead of more. Simple means that in this case we got more profit because we deduct less expense, because depreciation is an expense. If we deduct less expense instead of more expense, which means that it's liability because we get more profit in this reporting period instead of less because we were supposed to deduct more, which means that we owe SARS. It's liability. It's gonna be liability, just like that. Okay, now let's proceed to the next one. Statement of profit or loss. They said that received from High-Tech Limited for service to be rendered in March 2019, taxable in 2018, and rent expense for first quarter of 2019 paid in advance, deductible in 2018. Okay, let's start with the first one. If you check the first one, our company received an amount for next year. In other words, this is income received in advance. Okay, when it comes to income received in advance, remember guys, each and every transaction, because now we are dealing with accounting, each and every transaction is going to affect your accounting books. However, the question is always on this side. Okay, income received in advance, we are going to put it under liability, of course. It's going to be 250,000. Now the question is, does SARS accept money that is going to be performed next year? Remember, we haven't done obligation for this customer because it's for next year. What does SARS say about such income? SARS said that they only tax from amount that has been performed. Remember, if we don't perform anything to this customer, he might come back and claim what? His money, which means that SARS does not allow such income. In other words, there is no any amount that we are going to record under tax because we haven't yet performed obligation, which means that our temporary difference is going to be 250. It's gonna be 250,000. When we calculate temporary difference, we're gonna have 70,000. Now let's go to class. How are we going to classify this? Okay guys, This can be very simple for you if you watch part 1, because this is how you can do it in a simple form. Remember, I said that you have to create a journal first, then after that you can be able to identify by the journal of deferred tax whether it's going to be liability or an asset. You can do it in this way. Remember, income received in advance, we record in this way when we calculate or when we record our journals. We debit is income received in advance of service rendered. Ne? Okay, we can just say it, for example, we debit sales. In other words, we are subtracting it from income statement because it's in advance. We have to subtract it under income statement and record it under a balance sheet as a what? As a income received in advance. Income received in advance. Okay, this it will be P&L. This will be SFP. Okay, if you have this journal, obviously guys, it's going to be very simple for you to identify whether it's an asset or deferred tax liability. I said that if you have P&L on the debit, when you go to deferred tax, you have to do what? To credit P&L. Okay, you're gonna have journal like this one. Deferred tax and deferred tax on the debit, on the credit. Deferred tax. Okay, which means that P&L, because it was on the debit, this side will be on the credit, P&L. Then this side will be SFP. Just like that. They have to swipe what? The side. Very simple like that. Okay, now we need to check, is this an asset journal or liability? Obviously guys, remember, assets increase on the debit side, which means that this is an asset. This is an asset, deferred tax assets, which means that even when we come here, we're just going to say it's an asset. Very simple. That's how you can identify it in a simple form. Okay, we're gonna do it again on the next journal so that you will understand better. Okay, they say that a rental expense for the first quarter of 2019 paid in advance. So this is prepaid expense. Prepaid expense is like asset to us. Okay, how do we record prepaid expense? Okay, let's say for example this is an expense for rent expense, which means that we were going to create a journal like this. Prepaid expense on the debit, then on the credit, rent expense. Okay, let's classify. Prepaid expense is an asset, SFP, and this one is P and L. Okay, now when it's like this, it's very simple for you to create what? A deferred tax journal, which means that we're gonna say debit, deferred tax, and credit, deferred tax. Now because they have to swipe aside, P and L now will go to the debit, P and L and S FP. They have to swipe aside like the one that we did on the previous one. So simple means that now we can say that this one, obviously liability increase on the credit side. We check SFP because SFP, if it's on the credit, it's liability. If it's on the debit, it's an asset. So in this case, it's a liability, which means that we can go here and classify it as a what? As liability. Okay, we didn't record this side, but it's not a problem. It was going to be 167,000 here. Because this expense is prepaid. Tax, they don't do that. They don't do prepaid and advance. It's going to be 167, and the temporary different is going to be the same. Then after that, we have to calculate and get 46,760, just like that. Okay, now because we are done with the first part, the second part, they said we need to prepare the journal of deferred tax. Okay, number B. Okay, so 2 marks for that, which means that we can't do these journals separate. We need to add them together so that we can do it in one form. Okay, how are we going to do it? Very simple. We are adding all liability and we subtract assets, one asset, because we only have one asset, and obviously it's going to be liability in this case, because liability, they are more than assets. Okay, you can say 20,533 plus 39,900 plus 46,760 minus 70,000. Then we will get our deferred tax of 37,193. This will be liability, because liability amount are more than assets. Then now you come here and said, you can say income tax expense, this is debit, and credit deferred tax SFP, this is P&L. Then amount will be 37,193. 37,193. So this is how you should do a treatment of IAS 12, as we are going to part 3 as well. Please make sure that you have subscribed so that you will also check part 3, part 4, and part 5 as well, so that you can learn more when it comes to application of IAS 12 of deferred tax. I'm gonna see you on the next standard.